In the last session, we worked on one particular aspect of decision making using the costing information. That is, whether we should make a product or buy a product. That is what the question number 1, as you see on the screen, that is what was solved out there. We said that the study has been conducted if product A should be dropped, sales of product is about 200,000 per year, variable expenses is about 140,000 per year, fixed expense is 90,000 per year, and it says that if you drop the product also, that about 50,000 of these expenses, fixed expenses, will continue even if the product is dropped. So what we try to do is, we try to get back to this Excel sheet, and then as you can see on the Excel sheet on the screen as of now, we said that we took out the situations. I continue to manufacture, I drop the product. I am looking at what is the cost that I am going to incur if I continue to manufacture the product, and what is the cost that I am going to incur if I drop the product out. We saw that the contribution from continuing to manufacture the product will cover some part of the inevitable fixed cost. Please note, I am using the beautiful word called as inevitable fixed cost. Inevitable fixed cost is 40,000. The contribution of 60,000 covers some part of the inevitable fixed cost. So what happens? My loss is only 30,000 if I manufacture, and my loss increases if I do not manufacture, because I am not getting any contribution to cover the inevitable fixed cost out there. So what happens? The decision is, I will continue to manufacture this particular product. Though it is making a loss, I will continue to manufacture product till I find a beautiful better alternative, which is going to sort of offset the whole thing, but the alternative of not manufacturing at this stage does not exist, because if I do not manufacture, my loss increases at this stage out there, right. So that is what we talked about in the last class out there. Now I am moving to the next kind of decision making. I am using about 2 or 3 different kinds of decision making, that is all. So the second kind of decision what we are looking at is, do I manufacture the product in house or do I buy the product out there? Because there are, what happens is, there are let us say a specific raw material that is used for my production process. I can procure the raw material from the market, of course, yes, or I can manufacture in house and use it for my production. Now what is it that I want to do? Whether I want, is it going to be beneficial for me to manufacture in house, or whether it is going to be what is called as procure it from the market. Here what we see in this particular case is, we use the concept that is basically called as, what we call it as a relevant costing. So what is it we are looking at? We are looking at decision. When I am looking at decision, I will have to consider only such cost that differs between alternatives. That differs between alternatives out there. Now because I am making a decision, and second thing is, it has to pertain to future. When I talked about costing, I talked about something called a sunk cost, the cost which I have already incurred, which is irrecoverable. Such costs are irrelevant for my decision making. Such cost I should not even consider for my decision making, because it is irrelevant, it is sunk, it is dead and gone. When I make a decision, here what is the decision? Make the product or buy the product. If I make the product, what is the cost I am going to incur? If I buy the product, what is the cost I am going to incur? That is the cost that I am going to incur between these two alternatives, that is the difference that is going to be there. For example, let us in this particular case, I move to the aspect here. Now I say, what is the alternative? Make the product, buy the product. This is the decision. If I buy the product, what is the cost that I am going to incur, which is going to be different from other alternative. Same thing, if I am going to make the product, what is the cost that I am going to incur? Different from other alternative. That is all what we are going to consider. Let us go back to the problem and let us see, read this and let us see this. Philip Corporation makes about 4,000 units of part U13 each year. This part is used in one of the company's products. The company's accounting department reports the following costs of producing this part at this level of activity. It says that there is direct material, direct labor, variable manufacturing overhead, supervisor salary, depreciation of the special equipment. At 4,000 units, if a manufacturer, depreciation is 8.60 per unit, allocated general overhead. Now, what is the challenge? The challenge is an outside supplier is offered to make and sell the part to the company for $21.60 each. If this offer is accepted, the supervisor salary and all other variable costs including direct labor can be avoided. Now please, there is a change. What is the change? That is up to supervisor salary, variable manufacturing overhead and all these other costs, that is direct material, direct labor, variable manufacturing overhead and supervisory salary out there can be completely avoided. Now, the special equipment used to make the part was purchased many years ago and has no salvage value or other use. That means I have purchased a product out there and this product, I purchased a machinery out there. This machinery has no use, I cannot dispose it or it has no salvage value. So, what is happening? The machinery is going to be with me irrespective of whether I manufacture or not manufacture. So, what happens? The cost associated with the machinery, that is the depreciation in this case of the special equipment, is going to be incurred irrespective of whether you manufacture or you do not manufacture. That cost is going to be incurred irrespective of whether you are going to manufacture or not going to manufacture. Sir, if I am not using the machine, why charge depreciation? You are not using the machine. Can the machine be disposed of? No. Can the machine be used for something else? No. It's a special machine. It is going to lie. You have already spent money on buying it. So what is happening? What do you call it as the value of the machine which is not depreciated yet will have to be borne by the units even if you buy the output out there. That is a cost which does not vary between alternative. Next, I move on further. The allocated general overhead represent fixed costs of the entire company. If the outside supplier's offer were accepted, only 3,000 of the general overhead could be avoided. So, what is the total general overhead cost? 7 into 4. 7 into 4 is 28,000. Am I right? 28,000? Yeah. 7 into 4 is 28,000. 28,000. Out of 28,000, only 3,000 is avoided. So, that 25,000 will be incurred even if you manufacture or do not manufacture. So, that is a common cost. What are we looking at? Relevant cost. In addition, the space utilized to produce part U13 would be utilized or used to make more of one of the company's other products, generating additional segment margin of 13,000 per year for the product. So, what is happening? Your revenue is going to increase by 13,000 if you do not manufacture. If you manufacture, that revenue you are not going to get. If you are not going to manufacture, revenue you are going to get. Now, let us look at framing this whole thing out there. Let us look at framing this whole thing out there. I am going to cut the screen into two parts out here so that it is easier for us when we sort of look at it. In this particular case, I am going to just reduce the column width so that we can sort of see what do you call it as the entire thing out here. Now, let us look at problem number 2 out here, and then let us say I make the product or buy the product out there. That is, I make the product, next is buy the product. Make the product and buy the product out there. I am just going to what do you call it as wrap it up, so wrap the text so that it is clearly visible. Very clear and straight, simple out there. Now, I would say what is the number of units manufactured is going to be the same number of units in either case is going to be the same 4000 units, and that is what it is, 4000 units and 4000 units. Now, what is it I am looking at? I am looking at relevant cost. I am looking at relevant cost in this space out there. That is the cost that is relevant between these two alternatives. Let us go one by one out here. Let us go one by one out here. Let us say direct materials. What are the cost of direct materials? It is 6.20 per unit. How many units am I manufacturing? I am manufacturing 4000 units. My direct material is 24,800. If I make the product, if I buy the product, it is blob out there. I am not going to spend any material cost. Sir, you will spend a cost of purchase. Yes, we will come to that. Hold it. Hold it for some time. Next, I go into what is called as direct labor. I'll do one thing. I'll make this at 6.20. Okay. Next, I will say direct labor at what is called as 4.40 out there. Now, what is the labor cost? 4.40 into 4000 out here. This is the labor cost. If you manufacture, if you buy the product, it is 0 out. Now, what is it? Variable manufacturing overhead. Variable at, what is the price? 6.80. So, it is 6 into 4000 out here, and that is what it is. Next is again, if you buy, you are not incurring that. Next is supervisor salary. Supervisor salary in this particular case at the rate of, what is the rate at which they have given? 2.50. So, that is going to be 2.50 into what is called as 4000 out there, and this what is supervisory salary out. Now, in this, the next one, depreciation is an irrelevant cost. Why? Number one, it is an irrelevant cost because does it differ between the alternative out here? It is the same between the two alternatives. We are looking at cost which is relevant, which is pertaining to future, yes, but also relevant. In this case, depreciation of 10,000 or whatever is the amount out there, 20 depreciation. Let me go back to my depreciation part of it out here. Depreciation 8.6, 8.6 into, I am just going to do the basic calculation out here, 8.6 into 4000 units out there. The depreciation cost of 34,400 rupees you will incur irrespective of whether you manufacture or not manufacture. Why? Because the machinery, the special equipment cannot be disposed of and does not have any salvage value in this particular case, does not have any salvage value in this particular case. So, I will not even consider this depreciation. So, let me write depreciation is irrelevant cost as it does not differ between alternatives. As it does not differ between alternatives. I am just going to use this and let it be like this out here. Next is general, I will say next, what is the next cost out there? I will have to go back out here, allocated general overhead out there. Now, let us say allocated overhead. Now, what does the statement say? The statement says, if the outside suppliers offer or accepted, only 3000 of the allocated general overheads could be avoided. So, what is happening? If you manufacture the product, that is 25,000 rupees, that is 7 into 4 is 28, only 3000. So, 25,000 rupees of general overhead is irrelevant for decision making as it does not differ between alternatives, as it does not differ between alternatives out there. So, what happens in this particular case out here, if you look at allocated. So, what is the amount? 28,000. 28,000 is the total general overhead. That is, how do I get that? Let me get that also very clear. 7 into 4,000 is the allocated general overhead. Out of that, 25,000 is irrelevant out there. So, what is relevant? Only 3,000 is relevant. The other 25,000 you will incur if you make the product, if you buy the product also you will incur. So, it becomes irrelevant in this particular case out there. In this particular case, it becomes irrelevant in this particular case out there. Now, what is the next one out here? Next aspect out there. Let me go back to the problem. Let me go back to the problem and let us sort of read this. Let us make it full screen now and read this. In addition, the space utilized for part U13 would be used to make more of one of the company's other products, generating an additional segment margin of 13,000 per year. So, what is happening? If you make the product, you will not generate 13,000, whereas if you buy the product, you will generate an additional 13,000. So, what happens if that is what you call it as, what is called as opportunity cost out here. In this particular case, if I make the product, is opportunity cost is 13,000 because I cannot generate. If I do not make the product, I earn that 13,000 out there. I earn that 13,000 out there. So, what happens? Defer opportunity cost. Please note, I am not looking at it as a revenue, I am looking at it as an opportunity cost. I am not looking at it as a revenue. You can look at it as a revenue also. How will I look at it as a revenue? I will come to that as of now. Well, let us wait and watch. Then there is what happens. I buy the product. I buy the product. If I buy the product, what is the cost? I am buying, purchase price, buying of the product out there is, because I am looking at cost out here, I have not taken that. My buying of the product is about 21.60 out here, 21.60. So, what happens? If I buy the cost, what is my cost out there? 21.60 into the 4,000 units out there. This is the cost I will incur if I purchase this particular product out there. So, what is the total cost? Total cost between these two. If I look at the total cost, if I manufacture, total cost if I manufacture is 95,600. Total cost if I buy is 86,400. So, naturally the cost of purchase is reduced if you buy it. So, decision will be to buy the product and not manufacture the product. Decision will be to buy the product and not manufacture the product out there. So, what happens? What is the difference or incremental profit what you make if you buy incremental? If I buy what is the incremental profit? The incremental profit that I am going to make if I basically I am going to buy is about 9,200 is the incremental profit that I am going to make. Sir, this 13,000 you took it as an opportunity loss. Can I take it as a revenue? Yes, I can take it as a revenue. How do I take it as a revenue? I am just going to show you a small example out there. If I take it as a revenue, I would say this is what is the revenue, that this is the cost that I am going to incur for manufacturing, for purchasing this product, and this cost is going to be reduced by 13,000 rupees out there. I can just do that and I can knock out this 13,000 is not a cost out there. I have to take it on one side. I can just do it. Your answer will not vary much out there. Why did I not do it? Because we are looking at it from the cost perspective. We are looking at it from the cost perspective only. We are looking at it only from the cost perspective. So, what happens? I am looking at this particular case out there in this particular case. So, that is why we are looking at in this particular case, that is incremental profit if I buy is about 9,200. I hope it is clear. Let us go to the next problem. Okay. So, the next kind of decision what we are looking at in this particular case is, for example, if you look at a processing, let us say a refinery itself. I am not taking example of a refinery because that is quite complicated. As I have indicated, I have taken very simple numerical examples. There is always a feeling after you do this course or listen to the lecture that you give more practice problems. Please pick up any cost accounting textbook, or for the financial accounting what I have taught, please pick up any financial accounting textbook, start solving the exercise problems, that is all. So, if I will have to give more examples, I will have to give it only from the textbook. I have also given you some reference of textbooks out there for this course. Pick up those textbooks and then you can solve all the exercise problems out there, right. So, what I am solving is I am looking at only from the conceptual point of view. I am giving you only the concept, not beyond that. Now, I said refinery. When you look at a refinery, the process of refinery, at every stage there are outputs out. There are outputs at every stage, and sometimes these outputs can be processed further to get a end product also. So, now what is the objective of every company? Is it to process and get outputs at every stage? No, may not be. The objective of the company to maximize their profit, as you know. So, if I have to maximize the profit, I know what is the selling price, I know what is the process cost, I know to know what is the kind of process I need to focus on more so that my profit is maximized out there. What is the kind of process I need to focus on, or what is the kind of end output product I will have to get to ensure that my profitability, my profit is maximized in this particular case out. So, that is what we are going to focus on. That is one more kind of decision that you make out there. So, now in this particular case of problem number 3, let us look at Gelazo Corporation processes sugar beets in batches. A batch of sugar beets costs about $51 to buy from the farmers and $14 to crush in the company's plant. Two intermediate products, beet fiber and beet juice, emerge from the crushing process. The beet fiber can be sold as it is. I think as it is it is as sold as is, okay, as it is for $20 or processed further for $18 to make the end product industrial fiber that can be sold at $45. Beet juice can be sold at $41 or processed further for $21 to make the end product refined sugar that is to be sold at $62. How much profit or loss does the company make by processing one batch of sugar beets into the end products, industrial fiber and refined sugar? That is, how much profit or loss does the company make by processing one batch of sugar beets into the end products, industrial fiber and sugar or refined sugar out. Let us look at in this phase what are the alternatives you have. I am just going to go back to my Excel sheet out there. I am looking at problem number 3 in this particular case, and problem number 3 of course, yes, and what am I looking at? I am looking at various alternatives, I am looking at alternative A, I am looking at B, I am looking at C, and I am looking at D. There are 4 different alternatives that I basically have out here, and let us look at these alternatives, what is the cost and etc. associated. Alternative A, there is what is called as I get refined sugar and industrial fiber. Now, these are basically the outputs. What I am basically going to get is what I am writing out here. Second possible is I just sell it as beet fiber and beet juice. Third possible is I sell refined sugar and beet fiber. That is, the beet juice I process it further to make refined sugar, the beet fiber I'll sell as it is. Fourth alternative, I will process beet fiber for industrial fiber and what is called as and sell beet juice as it is. 4 different alternatives what I have. Now, let us look at what is the sale value of each of these. And that is, I will go back to the question out here. They talked about what do you call it as batches out there. They are talking about batches. Each batch, a batch of sugar beet costs about $51 and so on and so forth. What is the sale value? Sale value of what is called as the refined sugar is $62 and sale value of industrial fiber, what they say is intermediate products and industrial fiber is sold at $45 out there. So, the sale value of refined sugar is 62 plus industrial fiber is whatever it is 45 and the sale value is $107 in this particular case. That is all what we are trying to get out here. If I sell it as beet juice and beet fiber, I can get what you call it as beet juice and beet fiber. What is going to be the sale value I am going to get? I can a batch of sugar costs 51 and 13 the intermediate products can be sold, beet fiber can be sold at $20 and beet juice can be sold at $41 to 20 plus 41, 20 plus 41 and this is basically the sale value that I am going to have. Next I say refined sugar and beet fiber. Refined sugar and beet fiber out there is what we are looking at. Beet fiber we know is $20, refined sugar is $62 out there, 20 plus 62 is what I can sell it for. Industrial fiber and beet juice, let us go back again. Industrial fiber is 45, beet juice can be sold at 41. So, 45 plus 41 that is about $86 is the sale value. The cost at the end of first process, that is when I say first process is for producing producing beet juice and beet fiber, producing beet juice and beet fiber out there, that is what we are talking about in the first cost, first processing. It says that $51 is the cost of a batch of sugar beets costs 51 to buy from the farmers and $14 to crush. So, what is the cost at the end of first process, which is going to be common? 51 plus 14 is going to be the cost and this cost is going to remain constant for all the 4 alternatives out there. Cost at the end of second process, this case. What is second process? Refined sugar, industrial fiber. Let us look at refined sugar to process, industrial fiber processing second process $18, refined sugar $21. So, what is it? It is going to be 18 plus $21 in this particular case. That is what I am going to spend if I have to process it further. Beet juice and beet fiber, there is no second process, so 0. There is going to be 0 I am going to process. In refined sugar and industrial beet fiber, refined sugar. So, what is the cost of processing in the refined sugar? Cost of processing refined sugar is $21. Industrial fiber, what is the second kind of processing industrial fiber? $18 is what I am going to basically incur out there. So, what is the ultimate profit or loss of each process is nothing but this is the sale value, this is the at first process cost at the end of first process, this is the cost at the end of second process, and this is what I say for every batch I make about $3 if I process refined sugar and industrial fiber, and well, let us see if I process sell it as beet juice and beet fiber, I make a loss of $4 out there. So, that option I will not even consider. If I make refined sugar and beet fiber, again I still make a loss about $4, so I will not consider, and then I will look at this. Industrial fiber and beet juice, if I sell, I make an option of I make a profit of $3, and it is the same between option A and option B. So, what is the decision? Decision is, in this particular case, I sell as refined sugar, REFINED, N has missed out there, typo, refined sugar and industrial fiber, or sell as industrial fiber and beet juice, because my profit is going to be the same in both the cases. The other two options do not exist for me because they are not the optimal option, they are loss making options for me. So, I will not do that. Clear? Very simple, very simple case I took, but more complicated, pick up the textbook and start solving. I am looking at only driving home the concept, that's all.